Hey, welcome back to Right on the Money, the go-to resource for your financial decisions. Our guest today, Pat Ginefra, certified financial educator and founder of MyLifeBroker.com, an amazing website. And we've been talking about retirement in the world of COVID. But before we get too far, we do have, of course, MyLifeBroker.com, but office still in the same location?
Yeah, we're in North Wilmington, Delaware.
Let's talk about something that we were talking about off screen, which was the dangers of really 12 and a half years now, bull market. Things have been going nothing but up. You could throw a dart into the stock market and hit a winner. But we were talking about how dangerous that is. You want to tell folks a little bit about that idea?
Well, I mean, we're at a point where everybody's making money, right? Whether you have a good advisor, no advisor, or a bad advisor,
yeah.
Right? In the last 12 and a half years, equities, if you're holding equities, you're in a much better position than you were 12 and a half years ago. And it continues to rise. The market continues to go up, despite a lot of issues that are starting to surface. Inflation is starting to show itself again for the first time in a long time.
It sure is.
You've got a Social Security cost of living allowance this year that should be north of 6%.
And that's the first time in how long that we've seen a COLA?
First time since the early 80s that we've seen a COLA of that size.
Yeah.
So we feel like inflation could be here to stay. Mm-hmm. And you really need a plan for increasing income as you go through retirement. Whether you have a pension, or you're going to use your assets, you need to continue to grow those assets to meet the demands of the inflationary position that I think we're in right now.
I just want to reiterate this because we talked about it before, but the having a plan, because I know a lot of folks kind of do I'll worry about it tomorrow, or I'm too busy today to put together a plan, and you are a very big proponent of having a blueprint.
We are, because we know that once you have a track to run on, there's a lesser chance that you're going to get off track. Mm-hmm. When you're really not planning, but you're kind of happy with the returns you're getting, like I said, everyone is making money right now. Mm-hmm. You have to kind of look beyond that to understand what average returns might be for the remainder of your retirement, mm-hmm. and build a model that conforms to that versus what's happened, let's say, in the last year or two, yeah. with the markets going up the way they have. And then you need a separate plan for income, right? With the bond yield being what it is today, mm-hmm. you're not really being able to use fixed income assets to get the traditional income that you could have gotten. So you need other means to do that, and that calls for balance.
The search for yield on the safe side of things, the safe, boring side of things. I got a letter in the mail from my bank, and it was touting their CD rates, and I shook the envelope because I'm like, where's the rate? There's nothing in here. Where are you looking these days?
Again, depending on the plan that you have, because everyone has a different time horizon.
That's true.
For income. So really what we try to do is establish the time horizon that you have. The last thing that you want to be doing is locking in losses. So one of the things that you have to be concerned with in retirement is withdrawing money, mm-hmm. and getting into an adverse sequence of returns where the market's down at the same time you need to make withdrawals. Mm-hmm. You're locking in losses at that point. So you want to be able to avoid that. This is why we like to have a separate income plan. So you have a place to take money out of when the markets are down that's not going to lock in losses. So some people are going to use, traditional means to do that, fixed income. They might look at dividend portfolios, right? Although the actual stock itself, it still carries the risk. Some folks want to look at insurance solutions for that, but it's really going to depend on your time frame. If you have the ability to defer the money, that's one situation. If you need the money now, mm-hmm. that's another situation. So liquidity and then time horizon is really going to dictate, which course you go.
For somebody who had to either decide, they were either forced to retire early or they decided to make that decision, I think that really goes back to what you were saying before when you talk about your blueprint, the windows and doors, right? Am I getting that right?
Yeah, exactly, because the final configuration can change, but it's that basic plan. You have to understand how much risk based on your retirement time horizon that you can still maintain.
Sure.
And you also have to understand where the income is coming from. Do you have a pension, for example? Retirement has typically been built on a three-legged stool where you've got pension, mm-hmm. Social Security, and then your savings. A lot of folks today don't have that pension, so they really have a two-legged stool, which means they're putting a lot more pressure on the 401k or the portfolio to perform. But we may be at that point where the markets change to where you're not going to get the returns you got from the last couple of years. And don't forget, over time, the market's averaged 7%, not the returns of the last couple of years, which have been quite a bit higher than that.
Yeah.
So you want to make sure that when you build this model that it's going to be realistic going forward, that you're going to have a plan for inflation, for increasing income, and more importantly, that you understand how much risk you have right now. You know, there's a lot of different ways to make 5%, if that's your target goal.
Sure.
Right? You can dial the risk up, or you can do it without a lot of risk. There's ways to make 10%. They're not all going to be the same. So it really gets down to how much risk can you live with, what is the asset base, and what is the income requirement. All that takes a plan. It really takes some investigation. You have to be able to capture the numbers. And one of the key components that we like to feature in our plan is the tax savings and the taxes. Strategy inside that plan. Most people, when it comes to taxes, they're totally focused on what's going on this year. A lot of accountants are focused on saving you money this year.
Yep.
But in retirement, because of the required minimum distribution at 72, you know that at some point you're going to start decumulating that account and you're going to have to pay those taxes off.
Yep.
So it really makes sense to have a much longer term view of that plan than just a tactical plan. You have to be more strategic rather than just looking at what's going to happen the next couple of years. Yeah. You have to look at how you can save money on taxes over the rest of your life, essentially. Because don't forget, if you don't pay that tax obligation, your heirs are going to pay it.
We're going to take a break, folks. We're going to be back with Pat, and when we're back, we are going to talk about, well, one, taxes. I mean, we can't not talk about taxes. But in particular, we're going to take a look at the Secure Act, what it did to the inherited IRA. That used to be something totally different. We're going to talk about RMDs, and then also we're going to talk about housing just a little bit. That's coming up on Right on the Money.